Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. I am your host, Christophe Barnett. I am delighted to be joined in the studio this morning by Russell Napier. Russell is an independent strategist at and co-founder of the Electronic Research Interchange, ERIC, an online platform for the sale of high-quality, individually priced investment research. He lectures on financial market history and is the keeper of the Library of Mistakes, a repository of research relating to financial missteps and scandals. Mr. Napier is also the author of Anatomy of the Bear, Lessons from Wall Street's Four Greatest Bottoms, now in its 4th edition. Russell, thank you very much for joining me this morning and welcome to Money Sense.
Thank you, Christophe.
So let's dive right into your book, Anatomy of the Bear. In the book, you presented your findings relating to 4 major stock market price lows in the 20th century, 1921, 1932, 1949, and 1982. So we use the term bull and bear in financial markets, and many people hear this and they might be confused at what these terms mean. Now, what I've read, may or may not be correct, is that the bull attacks with its horns and drives the victim upward, and the bear attacks by slashing downward, and so you have the bull with the rising prices, bear with declining prices. How do you define bull and bear markets?
Yeah, there is no official definition of a bull or bear market. In fact, if you were to read the financial press, we seem to have them every other week. There's different definitions, 10% correction. That's not what I do in the book. The very fact that I'm only talking about 4 specific episodes means it's something more than just a fall in the stock market. So I've got a very practical definition of what a bear market is. It's a time when you can buy shares and then make a hell of a lot of money. Very simple. And If you look at the history of the last 120 odd years, there's really been 4 spectacular occasions when you could have done that. Now, just one other thing is I run a valuation screen on top of that, and it turns out that the times that you made a lot of money from equities were also times when, guess what, they were very, very cheap, though not everybody necessarily spotted it at the time. So very practical definition. When did you buy them? And then you made a lot of money, because to get that cheap, they had to have been a bear market before that.
Okay, so we'll get into valuations, but are you saying then, based on your research, that at the time you would have been able to identify them as bear markets? That's
why I wrote the book. I mean, that is the whole point of the book. It's supposed to be an identification procedure so that you can use this book to identify bottom of bear markets. In its defense, it was pretty useful in March 2009. The things that were in the book and things that you were supposed to look at did actually work out quite well. So there was a couple of different things. Now, one was valuation. Equities were not very cheap in 2009. But the other indicators I had in the book, which was looking at when this great fear of depression would pass, worked out pretty well.
So the book was first published in 2005, and so that was before the stock market declines in 2008 and then the low in 2009. So just to repeat, that was not, would that have been included if you had written the book after that?
No, it wouldn't have been included as one of the great bear market bottoms, and that would be primarily on a valuation basis.
Okay, well, let's get into valuation. So perhaps just describe some of the methods that you use in your analysis of the prices.
Okay. Well, one of the things I do is I run a course in finance, and in that course in finance, we look at every possible valuation metric for as long as we possibly can to try and find out if any of them work. And the answer, to cut a long story short, this will be 6 hours of teaching in 6 seconds. The cyclically adjusted PE and the Q ratio. Now, the cyclically adjusted PE is to look at the rolling average 10 years earnings for a corporation, not this year's, but entirely backward looking. And the Q ratio is measuring an equity relative to the replacement value of its assets.
So let's deal with them one at a time, because the cyclically adjusted PE, or CAPE, we've talked about that with previous guests on the show. And so PE is price earnings, so it's the price of the stock market compared with the average of the last, in this case, I believe it's 10 years of earnings, adjusted for inflation. And so it basically says, how much do you have to pay for $1 of earnings for the stock market as a whole? And then the second valuation you mentioned
is the Q ratio, which is looking at the assets of a company. So the first one we've mentioned looks at its earnings. Mm-hmm. That's a flow. The second one is looking just at the assets it holds. You work out the replacement value of its assets minus its liabilities, and that is the Q ratio. So is the company basically trading on the stock market at a big discount to the value of all its assets? Could you buy everything for $1, wind the company up and sell the assets for $2? that would be a discount to replacement value of assets.
And when we look back at history, assuming we can measure these two valuation metrics consistently, we see a sort of cycle where we go from low valuations to high valuations. And so what type of ranges do we see in terms of these valuations? So how do we know when we're at a high valuation or a low valuation?
Yeah, it's a great question. So the one market where we have a very long-run data series is for the United States of America. And that goes back to 1881 for the CAPE ratio. The ranges there, you're looking at a low of 6 and a high of 42. That sounds dramatic, but of course most time it's in a range much, much narrower than that. But the absolute extremes would be 6 times in about 1921 and 42 times in the year 2000. Average is closer to 16, depending on how you measure averages. Today, for the US stock market anyway, we're at 29. So we're at levels that only previously surpassed once, which was in the late 1990s. We're above the 1929 level.
So again, when we look back at history, we see that there are times when you could buy the stock market for $6 for every $1 of earnings. So if we just assume that you're going to get that $1 every year on $5, that's a 20% return just based on earnings. That sounds pretty good to me. But then if we look at 29 or 30 times earnings, where we're closer to now, does this mean that we have a lower expectation of returns going forward?
That's exactly what it has meant in the past. Yeah, you can look at these measures of value, and just you've put it very well. At very high levels, the chance of getting a good return are poor. Let me put a reasonably hard number on that. At 29 times earnings, where we are today on a cyclically adjusted basis, if you were to hold for the next 15 years, the average return is probably going to be positive, so that's good news, but it could be less than 2% real each year. Now, the long-run average is near 6, and if you buy Anatomy of the Bear and just buy at the bottom, you could be looking at 10 plus. Now, these don't sound like big numbers, but the joys of compounding are such that compounding at 2 is radically different from compounding at 10. So the current valuation for the United States stock market is suggesting historically very low returns. Interestingly, though, still positive, but here's the problem. If I tell you the returns are going to average 2% over the next 15 years, there's every possibility, and history suggests there's going to be 1 year in there which could be minus 60, but the average might still be 2. And the most important thing that investors have to do is to protect their portfolios from themselves. And there's a high risk that people will panic if they had a minus 60% year, and they might well end up selling at the wrong point. So 2% sounds all right, but actually, when you try to cope and run a portfolio, you'll find out that dealing with the bad years is the difficult bit. And you might well get frightened out at the wrong time.
We'll definitely get into some of the psychology and investor behavior that this causes. But just to finish up on the valuations, is it basically the same sort of lesson using the Q ratio that you see with the CAPE? Can we just agree that it's the same sort of analysis? And by those measures, 2008 would not have been included in your book.
Yeah, so this is the fascinating thing. One measures earnings, one measures assets, measuring entirely different things, but actually they stay very close together throughout history. And what you find in 2009, March 2009, is they kind of got to their long-run average. But of course, if you have a mean reverting series, you would expect prices to go well below the average. I mean, 6 is well below the average of 16. That didn't happen. So the valuation data suggests that was not a great bear market bottom because valuations returned only to average.
And just so that we don't lose all our listeners who are scared away by these low returns or negative 60% year, let me just mention that there are other markets which I hope we'll have a chance to touch on that have a higher expected return going forward, again, illustrating the point we make often on the show of diversification. Just again, looking at the last 10 years now, so we've had the 2008, which we've talked about. We've had quantitative easing, 0% interest rates, new market highs. We've just touched on valuation on extremes. What else in your current, in the most current edition of the book, have you added that enhanced your research originally?
Okay, so I wrote the book because I'm not an academic, I'm a practitioner. But the book was written from an academic standpoint to have a practical purpose. The practical purpose was to help you to work out when we reach the bottom of the market. So it's a practical guide. So the preface, which is the new edition, the preface just keeps updating the forecast. So if I'm proposing that this has a practical use. It would be disingenuous if I didn't make a forecast. Then we'll see how well the forecasts work out. So the last one...
We're recording this, mind you.
Okay. But that's my job, and if you live by the sword, you die by the sword. And the forecast is basically that the dollar is going up. Now, that's a forecast that I'm very happy to stick by, even though it's a few months since we published it. And that, I think, is going to create all sorts of problems for the world. And frankly, and this is a 1-hour conversation in itself, it means the breakdown of the current monetary system. And I think that is incredibly and inherently bearish for investors in the equity markets.
So the strength of a dollar, is that driven by the central bank policy, or what do you see driving that?
Okay, well, the dollar is a residual, if you like, from it has to go up against something. So it's not really anything specifically relating to the United States of America. That may have changed a little bit with the election of President Trump, who is protectionist, and a protectionist president may run a smaller current account deficit, which may be better for the dollar. But for me, the fundamental problem is Japan. It's a country where they have run out of savings. The government debt is so big. It's owned by their own people. That's a good thing. But the bad thing is they're running out of savings to fund any more. And historically, when a government starts using its central bank to fund this debt, then that means the currency is going to come down. Number two, in Europe, the political integration of Europe, which is essential to make that currency work, is, I think, failing. Third one is China, where China's long tradition of trying to grow it and export its way to wealth is also failing because the economy is so big now. And finally, far too much dollar debt in emerging markets. Now, that's a long list, but the dollar is a residual. And if those other countries really have those issues, and many of those issues are structural in nature, they're not cyclical in nature, then the dollar becomes very strong as we begin to realize just how big the problems are for the euro, the yen, the renminbi, and some of the emerging markets.
I'm glad you brought up some of the markets outside the United States, because we're going to take a short break. Join us again in 2 minutes as we continue our conversation with Russell Napier, and we continue to talk about some of the other non-U.S. markets.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands and sponsored by OneTradeX.
And now, more Money Sense.
Welcome back to Money Sense. I'm your host, Christoph Barnett. In the second half of today's show, we're going to continue our conversation with Russell Napier, financial market historian and author of Anatomy of the Bear, Lessons from Wall Street's Four Great Bottoms. So we've mainly been talking about the stock market in the United States, but let's continue to look overseas. So we often hear that we should buy and hold stocks for the long run, but you have markets like Japan, whose stock markets peaked in 1989 and is still 50% below the highs. What lessons can we learn from that bear market?
Well, we can learn a lesson that Warren Buffett taught us, which is price is what you pay and value is what you get. So you do have to, particularly for long-run forecasts, have a look at the valuation of the stock market. And on the measures that we mentioned earlier, valuation of by earnings, CAPE, or valuation by replacement value of assets, this thing started at astronomical valuations in 1989. Mm-hmm. And therefore, if value is what you get, you paid the wrong value. I mean, going back in history, the U.S. stock market was so expensive in 1900 that it was kind of lower by 1921. Now, this is the great emerging market. You got it right, but you overpaid. Investment really isn't any more different than anything else in life. You got to pay the right price. So just be sure you don't pay the wrong price. We've discussed the US. I think it's the wrong price. It's too expensive. As you had hinted, there are other markets out there which are not as expensive.
Well, let's talk about some of those. So just to finish up on Japan, did it get to a level where it would have been included if your book was a global book?
I think...
It's been struggling for a while, right?
Yeah, I think history will show that. I mean, when you look at these CAPE ratios for Japan, you don't get a low number recently. Mm-hmm. And when the market bottoms, you don't get a low number. You actually get a pretty high number. There are technical reasons why these things are different in Japan, particularly the depreciation policy. They have a very heavy asset base. They depreciate pretty aggressively, and basically it means that the earnings are probably lower than they should be. So I haven't written the book on Japan, but if I did, I probably would come to the conclusion that was a low if we adjusted everything properly for the same accounting standards they have in the United States of America. Having said that, Japan is heading to a dangerous place. This policy where you run out of domestic savings and use your central bank to fund your government does end with a significant decline in the exchange rate and significant levels of domestic inflation. Both things seem virtually impossible because we've been through 2 decades of very low inflation and a little bit of deflation in Japan. But actually, that's where we're going to go. Now, if you were hedging, if you had covered your currency exposure in the yen, then you're probably going to do very well in Japanese equities during that period. So personally, I've invested in Japanese equities, but I have covered my currency risk back into the United States dollar. So I think the Japanese equity market is one of those cheaper markets. Certainly people who look bottom up find lots of value in the stocks in Japan. I am very concerned about the currency though. So for anybody who's considering investing in Japan, I do strongly recommend that you buy a product, and there are any number of them, that actually hedge your currency risk back into whatever your base currency may be. And for most people, I guess that's the United States dollar.
And any other countries right now that appear to be cheap, or perhaps even going through a bear market, that would be an opportune time to invest for those higher expected returns?
Well, there are other markets which are cheap, but I'm not buying them personally. So that sounds like a contradiction in terms. The thing about this value parameter, which I mentioned, is that it is a very good forecaster of long-term returns, 15 years, but not short-term returns. So the markets that stand out as potentially being cheap are what's called the emerging markets. Personally, I'm not buying them. I think they can get a lot cheaper from here. Historically, they've done pretty badly when the dollar has been strong, and I think the dollar is going to be strong. But look, if you were taking a 15-year view and you had to buy equities, then there are some emerging markets that are worth looking at.
Okay, so many of these topics we've covered before, and the valuations in terms of with other guests, with the emerging markets being more attractive, especially relative to the United States, even though the United States continues to run. But we've also talked about other asset classes. We've gone over fixed income, which are bonds, real estate. We've had shows on commodities. Has your research covered bear and bull markets in these other asset classes as well, or have you concentrated mainly on the equity markets?
Well, by looking at these 4 periods and trying to do some detailed background reading and research on what was going on in the broader economy, by definition, I've had to look at other markets as well. Now, there are only 4 times when this happens, when equities get this cheap. Now, they're getting cheap for a specific reason, and that is deflation, falling prices. That's usually associated with a banking crisis as well, though not necessarily. Now, if you get a banking crisis, there's not many asset classes that are going to do that well. We've all just lived through a banking crisis. Clearly, the one that stands out is government debt. That is the one asset class that's going to do well in a period where you have a banking crisis. So that won't happen on every business cycle, but I just happen to have looked at the 4 biggest ones, and they are usually associated with something being wrong in the banking system. And you could expect asset prices to be falling generally. Certainly commodity prices will be coming down pretty sharply. Property prices are usually coming down pretty sharply. And the only assets that are usually going up is government debt.
And was that a U.S. only phenomenon, or did you have other currencies, other governments' debt going up in history as well?
Yeah, well, I didn't look at those in detail, but the ones that I did look at, particularly in the 1930s, other governments were going up as well.
So when we consider where valuations are and think about our long-term investment goals, and we look at all these different asset classes, we want to have diversification, including bonds, especially when we're at these high prices. Now, what happens when we have these low interest rates? Do interest rates have to go lower then to have that gain to protect us from equity declines?
Well, I mean, it's a really important question because, they say this, it's never different this time. But what is different this time is the level of bond yields. I mean, they are exceptionally low. Certainly by the summer of last year, they were low at levels that we really hadn't seen before in the United States of America. So we have to bear that in mind. That's why many people would look at bond markets and say, you can't make any money out of these. You simply can't do it because the yields are so low. And I think as a long-term investor, that's got to be true. I mean, if I just said to you that we should expect maybe 1.5% to 2% from equities over 15 years, I'd be really surprised if it wasn't negative for bonds over that
after inflation,
over that long holding period. Having said that, I still think it's a good time to own bonds today. Because if the dollar is going up and if global growth starts to slow, and particularly if there's any form of crisis in the emerging markets, then the go-to asset is bonds.
Well, let me put out an argument to that point that says that, so back in the tech bubble, 2000, we talked about valuations being higher than they are now. I think the price to earnings was up to 40. But at the time, you could sell and buy a U.S. government 10-year bond and earn 6%. Whereas now, we've just discussed the historically low interest rates, while you also have central banks not only continue to keep interest rates historically low on a relative basis, but also in some cases buying the equity markets themselves. So could it be different this time, and could central banks just buy equities and just be the buyer of last resort in the equity market as well, keeping interest rates low, and we have a different forecast?
Sure. Well, actually, it's kind of the same forecast, but maybe at a different time. One of the interesting things about what's happened in the last few years is that if I told you that you should always buy equities at 6 or 7 times, we would have told you to buy Greece a long time ago, and you would have lost a lot of money.
Sure.
So the important thing is, what's the difference between Greece and America? Well, there's a few. But the one that counts is one of them has an independent central banker and the other one doesn't. So I think you've hit on a really important point here. Countries with independent central bankers, when things get really tough, they'll just change the rules. America came off the gold standard in 1932 to fight this. Quantitative easing hadn't been invented. They made it up. The point is, things aren't really tough. Things aren't really tough. The economy is doing all right in the United States of America. But if the things happen that I'm talking about and the stock market comes down, I can quite easily and I conceivably see the Federal Reserve buying equities. But it's a reactionary thing. Let's go back to 2007, 2008. Quantitative easing comes in March 2009. Now, the Fed had done lots of things from 2007 to 2009 to try and stop it. They all failed. And finally, they hit upon the right one. So I think you're 100% correct. Democracies in particular will do extreme things and change the rules to make sure we never get really, really bad. But perhaps the interesting thing about the book is that the valuations of the equity market kind of tell you when things are so bad that things have to change. And we're at 29 times cyclically adjusted PE. At 6 times cyclically adjusted PE, anything is possible. And I think one of the crucial things I would point out, particularly for listeners in the Cayman Islands, to me, the obvious port of call for policymakers the next time things get really bad is actually capital controls and restrictions on the free movement of capital. We always think the answers have to come from central bankers, but sometimes they come from governments. And the number one thing a government could do to try and get what it wants is close markets. And that's effectively what an exchange control is. So we got to stop thinking that it's only the central bankers who react. Governments also react, and history shows they can react extremely negatively. And Greece and Cyprus both got exchange controls. Why? Because they couldn't reflate, because they don't have an independent central banker. So let's bear in mind that this is not just about central bankers.
So this leads well into the next thought I want to bring up, in that you're absolutely right. What stops markets from going down is you stop the selling, exchange controls. And so we mentioned investor behavior briefly, but it takes selling to cause prices to go down. So if we would all just hold hands and agree never to sell, the markets would never go down. But can we actually do this psychologically as investors who are driven by fear and greed? One of our previous guests, he tells a story that he goes around to speak at these different countries, and some of the countries have high valuations, and he tells them this is a dangerous time. And then finally he went to a market that had a low valuation. He was excited because he was going to be able to tell them this is a great chance to buy. But when he got them, he received the same level of hatred because by then they had lost all their money in the price declines of the market. And so can we avoid ultimately the selling that will continue to feed on itself and drive that ultimate bear market?
No.
So what can some of the investors do to prepare themselves mentally?
That actually is an incredibly difficult question to answer. The easy thing to do would be to never look at the stock market. You laugh.
What if I need to sell for money?
Well, that's different. But, some of the best investors just don't look. And it depends on your time horizon. Nobody should enter the stock market, in my opinion, if you've got less than a 10-year time horizon anyway. I mean, that sounds ridiculous to most people, but that is the time horizon at least you need to have. Now, if you're really going to enter for 10 years, don't look at the stock market. There may be no other way to stop yourself from doing something. The greatest cause of destruction of wealth amongst men is the inability to sit in a room quietly and do nothing. Now, I have paraphrased Blaise Pascal there, but if you can sit in a room quietly and do nothing, then maybe the equity business is for you. But you need to have at least a 10-year time horizon to do that. There may be no other way to protect yourself.
So how do bear markets end?
Well, that is the subject of the book, and that is pretty straightforward because I have put into that book the list of the things. Basically, the market's discounting deflation, falling corporate cash flows, and that equity, is not an asset. It's a bundle of assets and liabilities. So it can go to zero. And there are many individual corporations that do go to zero.
I think most, if you look back at the constituents of the stock market, most actually do go to zero. It's the outliers that drive the returns.
Well, I don't know about most going to zero. A lot of them get taken out. A lot of them go into M&A as well, rather than going to zero. So anything that stops the deflation, that pushes the cash flows up and saves the equity, is effectively what ends it. Now, in modern times, that has been the authorities themselves. Back to Greece, would the people of Greece, had they had the opportunity, vote for a policy that would have done that 6-7 years ago? Of course they would have. But they didn't have the power to do that. As a democratically elected people, it wasn't their central bank. They couldn't control it. But when you find any other society like the United States, like the United Kingdom, with an independent central bank, the clamour for something to be done to alleviate this pain, alleviate this bankruptcy, stop people losing their jobs, becomes overwhelming, and something is done. And I think that's why the euro is such an interesting study in what happens in a democratic society that has portioned off or given away that right to reflate to an unelected body that doesn't look after the interests of that country.
So you've given a very fundamental answer to that question of what stops it, but what about the practical sense of when people stop selling, then that'll be the end of the bear market. So what type of investors are the types who say we're not going to sell anymore, we're actually going to start buying? Well,
they have a very specific name. They're called value investors, and they're always out there, and these are depressing people who hang around all the time being gloomy. And then when everybody else is gloomy, all 6 of these guys get excited. And at the bottom, when there's not a lot of volume and most people have exhausted, you just need these guys to come in and start buying. Mm-hmm. They used to call them constructive interests. That's what they used to be called before they were called value investors. And today, what would we call a constructive interest? High net worth individuals. Mm-hmm. So there's always great big pots of money somewhere in the world, and they do begin to come back out. They hide. They run away. That's why prices come down. Mm-hmm. But at a certain valuation, these great big pots of money begin to mobilize and come back out again. Sometimes they call it the smart money. I don't know if you can call it smart, but it's smart in one way only. It's got a long-term time horizon.
I call it the bags of cash strategy. When you get bags of cash, good deals come to you. Russell, I'm afraid our time is up, but thank you sincerely for spending time with us this morning. Again, I'll remind the listeners that Russell's the author of Anatomy of the Bear, Lessons from Wall Street's 4 Great Bottoms. It's available on Amazon and other fine bookstores. As a final note before we leave, I wish to once again thank all of our listeners and remind you that today's show can be heard as a podcast on the CFA Society Cayman Islands webpage, and encourage anyone who has a question or topic they wish us to cover to please email us at moneysense@candw.ky. We have also entered into the realms of Twitter and have our own handle at MoneySense Be sure to follow us and post any questions or comments there. We will reply. With that, thank you once again. Goodbye, and please do listen to Money Sense again in 2 weeks' time.
Money Sense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands' #1 choice for online brokerage.